Okay, welcome everybody. We are, what is it, May 27th,
Yes, indeed.
2022. A
Mhm.
couple background changes for us, eh, Ben?
That's right.
Hey, you're in your new fancy office, and I'm in
Mhm.
our old fancy office downtown at headquarters. I like to say the
Mhm.
mothership of
Yes.
National Bank Financial.
Yes.
Yeah, so saying I've been down here all week. It's good to mix it up, get out of the
Mhm.
basement every once in a while. You're out of the basement now, right? You got a
They finally let me
yeah,
get out.
the family let you have an upstairs office.
Finally.
I haven't graduated to that yet. I guess I
No.
gotta put some more time and get some sort of certification for that.
Yeah, exactly.
Pardon me. Okay, well, let's get into it. It's kind of we ended on a bit of a high note here this
Yeah.
week.
Yeah.
It's been a better week than last, for sure. The last couple, I
Mhm.
think. Give us the rundown.
Yeah, so thanks everybody, and thanks everyone that watched the semi-annual, because that covered quite a few things. I think we've had about 40 people kind of review that, 40, 50 people now. And so we got some pretty good feedback. And one of the things that we've talked about and try to do is kind of simplify it a little bit and provide more realistic kind of objectives around what it means. So I've been trying to communicate that a little bit more. And I think one of the things that I tried to get across at that point in the semi-annual was that bonds are starting to pick up. The economy continues to slow very quickly, and we're into that period now. And so this week we saw bonds continue to go up. Where I looked across here, and bonds were up across the board for the week, but so were stocks a little bit better. And so we saw quite a few earnings come out this week. And I think I mentioned in the daily one of these days, yesterday or the day before, just on how challenging it's been with the retailers. And so this week, I think one of the things I did is I sold a little bit of Swiss francs and added to Snowflake. Snowflake is a cloud-based service, kind of competes with Amazon, AWS, and they I would say they missed earnings slightly. I think they guided lower was the big reason that most of these stocks are trading down. So I bought some at 116 and it closed out here at 130 this week. So that was positive. And some of the things that I did last week as well, where I sold yen and added to ARKF. ARKF was up, I think, about 10% for the week. So, as we get to these kind of this point, the question that inevitably comes is, have we bottomed from a stock perspective? And I think the answer to one of those is that no, I don't think we have bottomed. These kind of big rallies that we're seeing, these are typical of bear markets, where you get big 4, 5, 10% moves in days, and quite a bit similar to 2008 type moves. Like today, I saw stocks up. Some stocks that were, are down 80% this year, up 15 today. So these tend to be kind of bear market moves. So I don't think the stock market has, but I do think the bond market has. And so I think it's been about 3 weeks now where I think we touched 3.15% on the US 10-year at the top. And since then, we've been gradually moving lower, around 2.75, 2.75% now. So I think we've seen the top of yields or the bottom of prices on bonds, but stocks, I still think we have a ways to go because they haven't really fully priced in, which I think is the recession that we're in right now. And so being patient at what I'm doing, but taking advantage of overreactions in the market.
Gotcha. So besides adding a Snowflake, was there anything else you mentioned a couple things there as well. Anything else?
So nothing else, just adding to ARKF, as I mentioned. So
Yep.
nothing else really, but spending a lot of time looking at these names. So one of the companies that I'd bought in we'll say February of 2020 was Under Armour. And so Under Armour was down significantly through the sell-off in 2020, like February, March. The stocks come right back down to those levels again. So it moved up about 100%, and
Mhm.
then has pulled right back down to those levels where it traded in 20. Same thing, we saw Adidas hit a 52-week low this week. We're seeing Nike trading around 52-week lows. Some of the other kind of consumer names that we've owned in the past, like Coach and Michael Kors, and all of these names are getting trounced. As I mentioned, Target and Walmart. So lots of times looking at these, saying, are these are they starting to get attractive, and or are they attractive enough now to think about buying? Because I think these will probably be kind of the worst. Q2 of this year is probably the worst comp numbers. And so spending a lot of time looking at what names are overdone, and what names does it make sense to add to. But I really think that the next 4 to 6 weeks, and somebody asked me as a follow-up to our presentation last week, is, you said the next 4 to 6 weeks are important, but I guess I wasn't clear on exactly what that means. I think stocks sell off hard over the next 4 to 6 weeks, and there'll be a chance to be more aggressive, and bonds rally in that backdrop. And so the bond position, don't have any intention of changing, continue to add where and when that's appropriate. But the stocks are the places where I think the opportunities are going to come really in the short term. I've been doing it over the last couple of weeks as we talked, adding to Block, adding to ARKF, adding to Snow, like taking advantage of these little incremental adds. But I think the next 4 to 6 weeks is really going to be an opportune time to maybe push a little bit and get a little bit more aggressive than we have in the past probably year and a half.
Gotcha.
Yeah.
Okay. What do you got in Ben's charts for us today?
All right. Well,
you're firing that up. If anybody has any questions, as usual, just throw them in the Q&A section at the bottom there. There's a little button. Up, you can type that in. Be great. Well, Ben gets the charts up here. He's got some fancy ones for us.
Yeah, just further, most of the charts today are further kind of putting my case together around what I see happening in the world. And so these are Vegas listings. And so you can certainly look at other places in the world, but that market tends to be very cyclical. And so it's interesting to see how it reacts. And this is a snapshot of what's happened in the past week, so last 7 days. So new listings is rocketing up, back on the market, coming back up. Price decreases are up dramatically as well. And so it shows you how quickly the market's reacting to higher rates in a market that's obviously quite sensitive to it. But if you look at this 12 months ago, there's very few listings on the market, definitely no back on the market listings, and I'd say, zero price decreases. And so we're seeing this happen quite quickly. The same thing happening in Canada, but it's a little more difficult to get the real-time data in Canada. But this is what's happening right now in Vegas.
Wow. Yeah. And I think that's happening in a lot of places in the US. I have family that deals a lot with US real estate, and that's what they're saying. It's slowing in all the major markets now.
Yeah. So that's going to have an impact on the consumer. And so this is what the next slide is consumer credit. And so, there's been all this talk about how healthy the consumer is. At least that's what Powell says every single time that he speaks. And so this is a look at the cost of living going up. As I've been saying, inflation's been going up as a result of energy, food prices, all of these costs of living going down, and real consumption capacity. Obviously, the ability to spend is going down. So consumer credit, as I mentioned on the semi-annual, 229 million credit cards applied for in April. Of course, consumer credit is increasing at a rapid pace. So all of these things are saying, this is what happens in demand destruction recession driven by high rates and tighter financial conditions. And so what you want to own in this backdrop is bonds and cash and US dollars, and particularly longer dated bonds, government bonds. So all of these things continue to point to the view that this is what's happening in real time right now. So lots of thought around how to position for what's next. Two more, and then I'll hit the road on the charts. But this one is further information around the disposable income in the U.S. So, obviously we saw the spike here, which is the free money that was given out. So savings skyrocketed. You were at home, you couldn't spend money. So you had this kind of effect that people felt better, that Powell talks about, and Maclan in Canada talks about the fact that balance sheets are in good shape, and each household has a lot of money. So this is just a shot that this is the worst level we've been from a savings perspective since 2008. So the ability for the consumer to absorb these tighter financial conditions, so higher interest rates and higher consumption costs, is not true, because people can't afford it, and it's having an immediate effect right now. So that's an important metric to continue to pay attention to.
Yeah, very.
Yeah. So, and then the last one. So the other point that I tried to make in our review is that the central banks, love them or hate them, they play a major part for what happens to risk assets. So stocks, bonds, ETFs, real estate, art, wine, anything like that. It's all about liquidity that drives the value of those things. And so if you haven't seen this chart before, it is the S&P 500 in white. So this is the white line, which is the top one, and the other one is the central G4, central banks balance sheets. And so when you think about it, this is since 2006, is that the market has moved based on what's happened to central banks balance sheets. And so right now, the market has anticipated this tightening that's happening, and the balance sheet is trying to go down. So if Powell really has his mind set on reducing the balance sheet, which I don't think he does, but if he does, then we're going to see further downside in the broad market. And yields will go lower, so bonds will go up in price. And so I really think that we'll see the central banks of the world make a pivot where they decide to stop raising rates because of the other things that I say, which is a consumer can't handle higher rates, neither can the governments. And then that's when we see markets and riskier assets start to move back up quite quickly. It's not something that happens overnight. When I say quite quickly, it's the market. It takes months. So I think this is all happening in the next short 3 to 6 months here. So really important time. I think one of the best times in a long time. Oh, the best time since April of 2020 to look at getting aggressive with stocks.
Perfect.
Yep.
Well, good set of slides there. They were a bit gloomy though.
Were they?
Yeah, a bit gloomy today. I don't know what's going on with that.
Gloomy because you couldn't see them, or gloomy because they felt
gloomy. A little heavy today. A little heavy today, man. Hey, but it's reality. So here we go. All right. So next week's looking a little more sunshine, a little less gloomy.
Yeah, I think. Look, because I've gone through some of the worst bear markets ever. When I see these types of events happen, I know it's hard and painful to think about what's happening, but like you look at these companies and you look at some of these businesses and you say, is this appropriate? Are they trading at appropriate levels for where they should be? And you look at, as I mentioned, Under Armour as that example. They trade at like 10 times earnings at these levels. And so Well, when they traded at 40 times, did that make sense? No, but a lot of the risk is out of them at this point. So if you think these companies are going to zero, then yeah, okay, you run away and don't do that. But I think this is, I get excited about where things are because I believe how much upside almost everything has here. So we've taken a lot of the risk out in the last 6 months, and so I'm quite optimistic about what's ahead.
That's great.
Yeah.
I think myself and everyone likes optimistic Ben the best, right? You're more fun at parties that way too.
Yeah, that's true. That's true.
All right. Anything else you're looking to for next week?
So next week we have the Bank of Canada meeting on June 1st. So we'll watch that and what they do. I expect them to raise rates. Again, they control 0 to 12 months, so they control that short-term rate, that variable rate mortgage. I think they go one more time, 50 basis points, and that's the end. And so it'll be important to see what the market or what they say, what they do. Does anything change? Any of their comments change to signal what's going to happen next? But so that would be on Wednesday next week, and then FOMC doesn't meet till later in the month. So that'd be kind of the key kind of central bank interest rate happening next week. And we'll continue to watch what's happening. But, the companies that miss earnings are getting spanked, as I mentioned. So I'd expect more of that to continue next week, particularly with any of the retailers. So I'll continue to be on the watch for that.
Gotcha.
Yeah.
Okay, as we wrap up here, last call for any questions. And Ben, do you have any kind of final thoughts?
No, I think that's it. Lots to cover, lots going on. And as I say, I think there's lots of opportunities now. So I'm spending time going through that. If there's anything that you want to talk about, let us know. We are working all through the next few weeks here, trying to make sure we're well positioned for what's coming. And I think that's about it. Did you have anything else to add?
Oh, that's it. That's it for now. Next week will be June already, and last month before school ends. So that's good for everybody.
Yes, exactly.
Exactly. All right, everybody. Have a great weekend, and we'll see you next week.
Sounds good. Thanks. Take care.